The following is a presentation of TFNN. It is now time for Trade What You See with your host, Larry Pesavento. Now, Larry Pesavento.
That's going to work, Al. I'm telling you, it ain't going to work. Hello, folks. This is Larry Pesavento for TFNN. And I'm having a little technical problem here, folks. I'm going to have to figure out something wrong here because the echo that I'm getting, I don't know if it's any better now. I hope you can hear me, Al. We'll double test this to see if it's working okay. And if it is, I'll keep going. Otherwise, we'll try to get it fixed. The problem is I am totally deaf in my left ear, and it makes it really difficult for me to to hear anything when I have this echo coming on. So it's really difficult to do this. But I'm going to go ahead and pretend like everything is all right, and then we'll go on. We'll go on from here and see what happens. We'll see what I can do here. There we go. Maybe this will work better. I hope it's okay now, and we'll see how it's working. Anyway, folks, I have spent probably 15 hours this week looking at charts, going back over a very long time, and it's basically what we're looking at here is a situation in the stock market that frankly, I've never seen anything like this before. This is the New York Stock Exchange Index chart. It's on the weekly basis, and there are 6 patterns that are completing on this chart in near perfect harmony. We have a double top from 2007. We have an ABCD pattern from 2009 to 2013. We have a butterfly pattern from 2011 to 2013. We have a butterfly pattern completing now in 2013, and we have a 3-drive pattern from August to November, and then we also have a 3-drive pattern from May to November, and it's all coming here at the same price of 10,100 in the New York Stock Exchange Index. You just don't see patterns like this completing all together at the same time. There's a possibility that the market could explode to the upside and just keep going up for several years, much like it did in 1999. But this one certainly looks very, very ominous. The other thing that I wanted to bring to your attention is I want to switch over and go over to Germany and show you the German DAX. It is showing pretty much the same pattern, but it goes back all the way to 1987, and all of these are coming together right near the same level where the DAX is trading right now. This is occurring when we are having a situation where the Bradley model is starting to turn down, so we'll have to watch it very, very closely, in my opinion, because this is one of those times where you have everybody is very, very bullish, and there are very few people that are very, very bearish. You just don't find people like that. I happen to be one of them, but we'll see. This is the time that I've been waiting for. We're up in the price zone where we're supposed to be with all these patterns completing. It might not mean anything this time, but it's certainly got a lot of things telling us at least we should be prepared. We're frankly not much higher now than we were in May in the Dow Jones. The other markets have actually held up a lot better, but the Dow Jones certainly has not been able to, move up very much at all. Now, the next chart that I wanted to bring to your attention is the Dow Jones Composite Index chart. This is basically the 30 Dow stocks, and then 20 of the top stocks of the Dow Jones Transportation, and 15 of the top stocks of the Dow Jones Utility Average. Again, it's price-weighted. It's not cap-weighted like the New York Stock Exchange Index, but it's still showing that same type of pattern where we have a 1.27 expansion from the from the 2007 high, and we're having a 3-drive to a top pattern. We're having a butterfly pattern. It's just amazing how all these are coming together at the same time. Folks, I've been looking at charts I'm going on 6 decades. I've never seen one that comes together like this before. I'm not sure what it means yet, but it looks a little scary, in my opinion. I would be very careful up in here. We'll wait and see. I have some ideas of where I think if it does turn, we'll have a pretty good idea of what to look for. We need the Dow Jones or the S&P to get below 1733, and then I would assume that we are getting to the point where we are at a spot where we're getting ready to go lower. Now, yesterday we had a new moon and a partial solar eclipse. We're right in the zone where the Bradley model begins to turn down, and remember, it started up on October the 9th. That was the next day was the biggest up day the stock market has had all year. It was up over 300 points, but this tells me something because if it can go 300 points up, because fear is a greater emotion than greed, the next time we have a really severe correction in the Dow Jones, we'll have one day in there where the Dow does at least 500 points. And all I'm doing is I'm taking the 300 points that we went up and I multiplied it times 1.618, and that gave us the 500 points down. I did this same type of analysis with Bill Griffith on the old FNN show back in 1987 before the crash, and we were talking about it, and I said sometime in October we would most probably have a day where the Dow would be down more than 500 points just based on the expansion numbers of what had happened on the upside, because the market really doesn't do anything different. It's just basically repeating what it's done in the past, and what we're trying to do is to try to find some of that, repetition. But since May, the Dow closed at 15,430, and today we're 15,600 and change. So 200 points is really not very much over a 7-month period. So this is going to be an interesting situation that we have going. But the long-term charts that I've looked at here are just really they're beyond amazing. That's about the only thing that I can show. The next one I wanted to bring to your attention is the monthly chart of the NASDAQ, because we have now completed a perfect 61% retracement of the high from 2000. That's when we had the internet bubble, if you'll remember, and that's we right at a 61% retracement that we made on Thursday's high. What's interesting is the ABCD swing from 2009 to where we are now is perfectly symmetrical. In other words, the AB leg is perfectly symmetrical to the CD leg. So this is going to be relatively interesting where we are now, because if we have a really strong day in the next couple of days where the Dow is up more than 200 points, this is telling us that this pattern would be failing and we would be going, to much higher ground. But if it in fact turns around and goes lower, then that would say, yes, maybe this pattern is getting ready to happen. The problem with it, folks, it's really scary, because you'd be looking at a top, very similar to what we had in 2000, and the NASDAQ, gave back, well over 80%. It went from 4,975 all the way down to just above 1,000 in the NASDAQ over a 3-year period until it bottomed in late 2002. So these are the things that we need to, keep in mind, that this pattern has nothing to do with anything as far as, what the, fundamentals are, because I don't know the fundamentals. That's pretty much the bottom line. But there's one other chart that tells us that we're very close to, something of pretty major significance, and that's the VIX index, because we're down at the same level where we were in 2007 and 2009 and 2011 and 2010, 2012, and here 2013 we're down at this level of 13. And, we've seen very little fear come into the market since 2010, and this market is, because of this long base that we have here, has a tremendous possibility that we would be getting ready to move to the upside. This chart reminds me a little bit of the dollar-yen trade that Tom O'Brien talked about last year, when the yen was trading at around 74 to 75 for weeks and weeks on end, and when it finally turned to move, it went all the way up to 103, I believe, in the dollar-yen. This is the same type of pattern that we're looking here, where we have rising bottoms and long periods of consolidation where people have a pretty much lack of interest in what's happening in the market. But in fact, it's really quite amazing how this thing actually fits together. I haven't seen these patterns come together on everything like this for a very, very long time. That's the bottom line. Now, if we look at the Dow Jones Utilities, you'll see that we've had some divergence here because the utilities have not made a new high by since way back in April, and now we've had lower tops through here, and we're just rallying back to a 61% retracement in the in the utility index. The next one we want to look at, of course, is the at the same time, and now we're approaching a double top now in the Dow Jones transportation. So it's getting very interesting in here with all of these patterns and everything coming together at the same numbers. It's really quite amazing. And also, not only that, but we're also coming into a time, where we're having some really active, cycle formations that are occurring. These are these transits or aspects that we look at, that we go back and we test them statistically to see how often, the markets turn on these particular aspects, and that's what we're trying to do here, is to take a little bit of time and a little bit of price to tell us that this is an area where you want to be looking to be a buyer or a seller, within this zone of time that you're following. So that's what you're doing with pattern recognition, is you're going into the past, moving out into the future to tell us where we are as opposed to the price and time of the things that we're looking at. Now, I'm probably not going to be able to finish this segment until the break comes, but I wanted to start it. One way of looking at this is to see where we are right now and then go back into the past to see where you were at other previous tops to see if you saw, the same types of patterns occurring. Well, I posted into Tiger TV a weekly chart of the E-mini S&P. As you can see, there are 3 drive to a top patterns that both end at the 1772 level. The smaller one that's taken since August through November to fulfill is very similar to the one that's happened on the NYSE, because these same stocks that are in the S&P are also. Okay, we got to take a little break here, folks. 877-927-6648. The Dow is down 9. The S&P is up 5.
Daryl Martin coined the phrase diagnostic trading, and we're happy to announce that his diagnostic box spread analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Daryl Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads. You take a hands-on approach to managing your investment strategy. You're always looking for the next trading opportunity to magnify your perspective. Direction Shares connects sophisticated traders with a powerful array of ETFs from a wide range of asset classes. The markets may go up and down, and you want tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foreside Fund Services, LLC. TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com. Andy Hecht, the host of the Commodities Hour, recently launched his newsletter service, the Technomental Commodity Report, and only 6 weeks in, Andy has already recorded a triple-digit winner. Andy advised his subscribers to purchase a long-term call option at 46 cents on July 11th, and then sent out a special update Friday, August 16th, advising his subscribers to close that position at $1.40. That's a 204% profit in just 5 weeks. The Technomental Commodity Report by Andy Hecht is released each Thursday morning, and right now you can get a month-long free trial to this subscription while locking in the low introductory rate of only $39 a month. Andy Hecht has been a commodities trader for over 3 decades. Let his experience work for you. Sign up for your month-long free trial to the Technomental Commodity Report today at TFNN.com.
Larry takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Okay, folks, we're back. The Dow's down 9, the S&P still up 5, so NASDAQ is up a little bit, so not too much happening. Well, we're going to take a look now. We've already looked at what's happening now with the S&P over the weekly chart. We've completed 2-3 drives to a top pattern. Now, if this pattern is any good, we should be able to find it near the top of 2007. So what I did was I went back and looked at 2007, and as you can see, we were making that same 3 drives to a top pattern at a big ABCD at the same time frame. And remember, the Dow went from 15,800. Well, excuse me, the S&P went from 1,586 all the way down to 666 over a period of 18 months. So whether this market is going to be that way or not, I'm not sure, but it certainly has the potential. Now, the next chart that I want to show you in this series, I think, is probably the chart of the week, the chart of the month, maybe could be even the chart of the year. And if you'll give me 1 second, I want to bring this to your attention because it's very scary, folks. This is a chart that came from Motley Fool, and basically what it's doing, it's showing the margin debt that is being held by people in the market. And as you know, there are many more people bullish than the market than there are bearish. There are some people that are looking for maybe a 10 or 20% correction. Nobody that I've seen yet has been looking for something like what I'm looking at. I think we're going to, really have a heck of a move to the downside. Whether that's going to occur or not remains to be seen, but the patterns are certainly there, and the timing is certainly there. We'll have to wait and see if everything falls into place. But as you can see, margin debt peaked during the internet bubble. Now we are above the highs of that internet bubble with margin debt, and we're also above the internet or the housing bubble of 2007. We also have more debt then. So we have a situation where the market's making all kinds of patterns to the upside, the completion patterns, and at the same time we have record number of people borrowing money to go long stocks. And that's one thing you don't want to do is in the stock market, you hold that stuff. You don't have to do it on margin. If you're a trader, you use margin, but you're an investor, you don't want to use margin. That's not a smart thing to do, because when the big sell-offs come, you're forced to get out. And if you don't use leverage, you probably won't be forced to get out. That's the bottom line. But most people use leverage the wrong way anyway. So we'll have to see what happens with this particular chart. But it is the most bearish of most of the things that I'm looking at, because of the fact that it has a high probability of occurring. It looks just really amazing that how many people are buying stocks here on margin at a time when they ought to be being very careful. But you see, I'm biased because I'm just a technician. I'm not listening to see what earnings are supposed to be, or what else is happening in the world. I mean, we got some wonderful technical products out there. My favorite one, of course, is Google, and it has held up incredibly well, being at $1,000 a share. But at the same time, that when Google finally does turn down, it will be probably for a considerable time. Now since we are looking at Google here, I'm going to bring it up and just give you a quick eyeball here before the next break. Is that Google left this huge gap between $900 and $1,000 a share. Folks, gaps are filled, especially gaps like this, which is an exhaustion gap. It was on near record volume, and the people were there that day when the earnings came out. Say, "Oh, please let me in this stock." And you couldn't get them to buy it at 400, 500, 600, 700, 800, 900. But at $1,000 a share, they please let me in. And so what do? You have record volume occurring with this exhaustion gap. Now, this gap will be filled. The question is, when will this gap be filled? Will it be in my lifetime, or maybe in someone who's in their 20s lifetime? I don't know, but this thing will be filled. My guess is it'll be filled sooner rather than later. Now, there's some stocks that are in the news that were involved in the last time we had a major bear market, and one of these is Goldman Sachs. And as you can see from the chart on Goldman Sachs, it's been in a downtrend since September, after it made the double top in the July-September time frame, which was also a three-drive pattern. Okay, folks, the Dow's up 4, the S&P is up 5, and not much is happening. Gold is up 6.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock and option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors. Basil Chapman has just announced that he will be hosting a one-day online master trader class. Friday, November 8th, Basil Chapman will teach you the essential fundamentals he uses when trading the market with his Chapman Wave methodology. Included in this full-day online master trader class is 1 month of Basil's daily newsletter service, The Opening Call, a $128 value, as well as a copy of his CD book introducing the Chapman Wave methodology, which usually sells for $249. Join Basil Chapman for this powerful one-day online master trader class Friday, November 8th, which will be archived if you can't attend live, where he'll give you a complete understanding of the Chapman Wave methodology and how to apply it to profitably trade any market in any time frame. For all the details and to reserve your spot while taking advantage of early bird pricing and saving $200 off the regular price, visit the front page of TFNN.com today.
No matter where you listen to TFNN programming, we want you to know you can always access your favorite shows on demand through TFNN.com. TFNN airs live programming every market day from 9 a.m. till 6 p.m. Eastern, and you can view each program by accessing Tiger TV through our homepage. We even have an easy link for all mobile devices, including iPhones and iPads, located at the top right-hand corner of the TFNN homepage. You can use your smartphone to view Tiger TV, but if you don't have a mobile connection that can keep up with streaming live video, then you can simply visit TFNN.mobi in the browser of your smartphone for live streaming audio of all of our programs. The mission of TFNN is to educate our audience directly and interactively through our interactive website and radio call and talk shows. TFNN is able to teach all levels of investors the technical skills needed to trade in today's marketplace. In order to get the best information possible, TFNN has assembled the most respected financial minds in the country to provide the most current news and comprehensive advice available. TFNN.com. Educating investors. This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
Okay, we're back, folks, with the Dow up 3 and the S&P still up 5, doing very little so far. We've got a caller on the line, our friend from Jackson, Mississippi. Brian, are you there?
Yeah, Larry. Thanks for taking my call. I appreciate it.
My pleasure, my friend. What can I do for you?
I've got 2 positions open right now, and one of them's not doing very good. The other one's doing okay. It's the first one is GLD.
Mm-hmm.
I got into it Friday, and it's up a little bit, but I wanted you to take a look at it. And also, while you're looking at it, usually when the S&P or Dow tanks, would gold follow that?
Well, I think it's going to this time because we have so many people that are going to be liquidating positions because of this margin debt that we have. This is, record area, and usually they don't let them out at the high. That's what history tells us. So, gold has had some really chances to break out to the upside, Brian, and it's not been able to do that. And we really need it to get above 1370 to tell us that it wants to go higher. And if we go below 1305, and we're only $12 away from there, I think we can have a chance to, break out 1250. And below 1250, it's in trouble because that means it's probably not going to make a double bottom at 1170. So you just have to be real careful in here. But it still has a chance. I posted the chart into Tiger TV. You do have a small head and shoulders pattern forming with strong support at around 1305 in the gold, which equates to about the same price in the GLD. So $1,300, that's what you want to look at. If it gets below $1,300, I think gold's got problems.
Right. Okay. Well, I knew a couple of weeks ago you were starting to get a little bullish on gold, but since then you kind of changed your.
I mean, it had a nice rally. We were looking at it at the 1255 level, and we haven't gone below that level yet, but it's not really gone very much. So that 1250 is incredibly important, but it just should be moving on a little bit faster. That's the main thing that we're looking at here.
Well, I would think if there was some big financial crisis that gold would be something people would go to, but it seemed like it hadn't worked out the last few times that we've had sell-offs. Looking at that.
I know, Brian. Yeah, if you see the people going to it and they're buying it, that means you want to follow those people. And if they're not buying it, there's the reason for it going down. You had another question. You said you wanted to ask me about another stock.
Yeah, I had UNG. I got into it around $18 on an option, and it's gone nothing but south since then. And I just wanted you to take a look at that one, see what you thought.
Hey, the UNG is an ETF for natural gas, and it looks like it's making a double bottom here at this level of around 17. I see that it gapped down today, probably in relation to what gas is doing. But as long as it holds that $16 level, I think you have a chance on this particular one. 18 is certainly attainable if it starts to rally from here, but it really needs to hold that $16 level, or else your option's going to be in big trouble.
Well, I've got until January, and strike price is 20, so I'm hoping that a cold snap will rally it up.
Yeah, that old hoping word, that's not a good trading word, my friend.
That's true. I'm just kind of watching it and, just seeing what's going to happen with it. I appreciate you taking my call and answering my questions. Thank you.
Well, thanks for calling in, Brian. You live in a great part of the country. Okay, we got another caller from another great part of the country, from New Hampshire. Lou, are you there?
Yeah, Chile, New Hampshire. Yeah.
How are you? What can I do for you?
Okay, the S&P, short term, maybe till the end of November. What do you see it happen?
Is this short term? You mean what do I see is going to happen in November?
Right.
Well, long term, of course, I'm exceedingly bearish, and I think that the Bradley model has basically topped. The S&P, to me, if it gets below 1733, it's almost a mortal lock that it's going to go below 1700. And the price projecting that I would have for, I'll put up the S&P chart in just a second, but the price objective that I have for the minimum price objective on the S&P for this part of November would be the area of around 1700. That's a 1.618 expansion of the last 5 days move. But you got to remember, Lou, I am really bearish for a lot of reasons. And if I'm wrong, this market's going to get above 1780, and I will be wrong. And if it gets below 1730, I'll be right. So that's what it's looking like to me. But the number of 1700 is just a 61% retracement back from the low we made in October. It's nothing, really dramatic. We could easily go to 1597 in October.
Mm-hmm. Well, okay, I appreciate that, Larry. Thank you.
Thank you, Lou. The whole thing, Lou, is this margin debt that's out here. That's not good. This is not a good thing to have happen. I know margin's wonderful when things go up, but when things go down, margin is not the thing to have, and this is the problem that we're having in the stock market right now. So be careful, if you're in the long side of this. The trigger mechanism for me, of course, is the area of the 1733. If we go below that, then that would be the area where I think these market would turn down from.
Okay, super.
Thank you for calling in. I really appreciate it.
I appreciate you.
Thank you. We got one other caller, but someone asked what the next Bradley date is. I'll cover that. It'll be around the 15th of November. But we got a call from Philadelphia. Sam, are you there?
Yes.
What can I do for you, my friend?
Good morning, Larry. How you doing? I'd like you to look at General Electric GE. I purchased at 25. It looks like it's forming an ABC up to 28 something. I want to see your projection on that.
Okay, give me a second. Oh, it's had a big run here recently. Just 1 second here. Must have had some news in the last few days, I guess.
Yep.
Yeah, you've just completed a big ABCD butterfly up in here. I would be getting out of this stock now. You've had a really good, wow, this has got some interesting things. I wouldn't be in this stock very much longer. You're absolutely right. You completed that ABC up here at 26 and change. And, so you either put your stop at break even and let it ride, or I would take it off right now, because you're right at a 1.618 expansion of the July through September area. You know what I mean? So you've got to be able to take some money off the table in here. So my suggestion would be to take the money off the table now.
Perfect. Okay. Thank you.
I don't know if it's perfect or not, but it looks like it is. And you've got a huge gap there at that 25 level, which will be filled, because, General Electric is one of the most avidly held stocks. I think it's the number 2 or number 3 stock in the world that people hold in their portfolios. So, it's going to fill that gap at 24.5 sometime soon.
Yeah, I made a good profit now. I can get out now and wait for retracement to buy back.
Yeah, and if it doesn't buy back, you can blame it on me.
No, I can buy another one. There's always another day, as long as you're making money, Thank you very much, Larry.
Thank you for calling in, Sam. I appreciate it.
Okay. Bye-bye.
Bye. Well, I forgot to I'm going to put the butterfly pattern that is in General Electric also that's in here, because it's also making a beautiful butterfly pattern up in here at this area of 26, and I would rather be short than long this stock from up in here. So, that's what I'm looking at. But just about every stock that I'm looking at, it's got some type of a negative divergence, to it, to the downside. So that's, part of the problem that I've had and boy, folks, I looked at this stuff so much over the weekend that my eyes were getting blurry, that I went back to see if I'd ever seen a pattern like we have in this New York Stock Exchange Index and some of these others, where all of these patterns are coming together, with this lovely symmetry and the Fibonacci numbers coming together and everything. It's just really, really quite amazing to, to see it happen, because it's truly a work of art. Now, one of the arguments that you get about the stock market is the fact that the reason why, stocks are so very, very bullish is because that China is going to be, the instrument that takes us, out of our quagmire here with employment and stuff like this. But if we take a look at the Chinese stock market by using the FXI, you'll see that it's making a huge head and shoulders top going back to January of 2012 is your shoulder. Your head is at January 2013, and now your right shoulder is coming in now, and it's also a bearish-Gartley pattern that has formed over the last 5 or 6 weeks also. So this is telling me that, China is, and believe me, if you look at this on a longer-term basis, this has been in a downtrend since 2006. So, this is going to be hard. It could change. If the market, the Chinese market turns strong and runs to the upside, that certainly could, be a situation that might pull us, to 17,000 in the Dow and 1850 or something in the S&P. There's always that possibility. So this is what we're watching here, is the fact that the Chinese market should not be, helping it, because it just doesn't look that strong or bullish in the Chinese market to help what we're doing in the stock market, without any idea. Now, last week we were talking about the euro, the harmony that we were looking at in the euro, and of course the euro had a very big move to the downside this past week. If you give me 1 second, I'll put this in Tiger TV, so we'll be able to see it. I'm going to put it in on a longer term, because this has had such a big move that it's really quite remarkable to see it occur while it was moving. So I'll put this in, and you folks will see that the market stopped exactly to the 618 of the previous swing, and made a beautiful Gartley there, and has now moved 400 pips down, and we're looking to sell that first ABCD correction that you might get, following a big move like this. But on a weekly basis, we haven't left a bar to the downside that strong since late April of 2012. So it looks like the euro has certainly kept its downtrend in case, because we've had lower tops ever since 2008. We had a lower top in 2009, a lower top 2011, and now we've had a lower top in 2013. If this is in fact the top, but it's come down so quickly in such a short time frame, that usually is indicative that the position is getting ready to continue to the downside. The last time we had one of these, just a few months ago, back in March, the market dropped over 700 pips in the euro, to the downside. So these are the things that we're keeping an eye on. The same thing is true in the British pound. We've had a lot of activity to the downside, and it has been much weaker than any of the others. Now, the one that we also watch, because it's such a primer for the Japanese market, and that's the dollar-yen trade, because that's still a very important market, and we have been moving in a very, very tight pennant for a very, very long time, and we're still in that pennant right now, but it looks like it wants to break out and go up to the level of about 99. We're trading at 98 and change at this particular time, but there's a pretty strong probability, because these bottoms have been higher, that we're going to get very close to the 99 level, which is nothing more than another Gartley forming in a bearish trend, and that would be an area where you'd be looking to sell. However, and this is a big however, and this might be the hummingbird that's in the wrong pen, or whatever you might say, but if this market happens to pop its head above 103, that's a long way from where it is now. It's about 700 pips, about 500 pips. But if we should happen to pop above that level, that would mean that the Japanese stock market is going to get very strong, because the correlation between the dollar-yen and the Nikkei is very high. It's about 90%. That could be the thing that maybe it will turn our markets, because we're in such a global environment. But folks, we are seeing these. I've showed you the DAX. I didn't show you the FTSE. I didn't show you, the French market. I just don't have time to put everything up there. Besides, we don't trade those anyway. But if you looked at them and took the time, you'll see that all of these patterns that we're seeing now are completion patterns. They're not as perfectly complete in the New York Stock Exchange Index, but they are complete, and they are ABCDs, and they are doing the ratio at either 127 or 1.618. So it's a time of major caution if you're long stocks. Remember, the Dow has gone very little since May. It was 15,400, and today we're 15,600, with the Dow being down only 4 points. So this is what you've got to keep in mind, is that unless you were in some of these tech stocks, then you haven't really participated. And when you look at what these kids have done, these young kids, with the things, how they've changed us with social media, and we got to take a little break here. The Dow is up 2, the S&P is up 5, and gold is up 4.
Have you subscribed to the Gold Report yet? On Wednesday, August 14th and Thursday, August 15th, Tom O'Brien advised his Gold Report subscribers to close out 6 of their 9 open positions, all winning trades ranging from a 10.69% profit to an incredible 48% profit in just one equity. Tom O'Brien brings an incredible wealth of knowledge and experience to the gold market and the equities within the industry. That's almost 12 years since this powerful newsletter first began. And right now, you can get a 30-day free trial to the Gold Report by visiting TFNN.com. Make sure you're a subscriber as this volatile gold market makes its way back into positive territory after declining all the way from $1,900 to under $1,200 an ounce in only 2 years. Get your 30-day free trial today by visiting TFNN.com.
with the launch of Tiger TV. TFNN has brought our programming to the next level. With Tiger TV, you can gain access to each host's charts and computer screens as they host their daily stock program. Whether it's Tom O'Brien, Steve Rhodes, Basil Chapman, David White, Larry Pesavento, Andy Hecht, Victor Jones, or Terrell Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV, then visit TFNN.com and see what you're missing.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today. Wouldn't it be great if you could get a red light, green light indicator that gives you signals on 25 different futures contracts? Now you can with Taz Signal Box. This red light, green light market profile system dynamically updates 24 hours a day and provides you with important trend and trade signals on 9 different commodities, 9 different indices, and 8 different currencies. Right now, you can receive a 2-week free trial to Taz Signal Box. For all the details and to find out how the Signal Box works, visit the front page of TFNN.com.
Patterns, profits, and peace of mind.
Are you looking for a precision edge in the market? Something that can stack the odds in your favor? Then look into Larry Pesavento's trading newsletter.
Patterns, profits, and peace of mind.
In each weekly issue, Larry explains what's going to happen in the markets based on the pattern he sees developing and gives you actionable trade ideas based on those patterns. Plus, you'll get his detailed analysis on a variety of markets and sectors, including stocks, treasury bonds, the gold market, oil, the dollar, the Forex market, and more. You'll get access to all the patterns Larry is seeing in the markets, plus the Astro Harmonics and powerful Bradley stock market model that Larry utilizes for less than $5 a day. An extremely potent combination that will give you the edge you've been looking for. Try Patterns, Profits, and Peace of Mind absolutely free for 2 full weeks. That's an $85 value. Yours free when you register right now.
Get Larry's Patterns, Profits, and Peace of Mind.
And get the edge you've been looking for.
This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
Okay, we're back, folks. The Dow still down 5, the S&P up 4, and the NASDAQ up 4, and gold still up 5. By the way, those of you that are out there that are learning this business about investing and trading, Basil Chapman is having his Master Trader series coming up really soon, and it's really a great value for people that want to understand the technical part of the market. It's not fundamentally based, which is the best part of it, and he's got some great rules, and he follows these rules empirically, and it's really a great thing to learn if you want to learn to understand about trading. It's one of the advantages that you have with TFNN is that they provide a lot of information. And it's good information, too, and it's always fairly priced. So if you have a chance, go to Basil Chapman's workshop that's coming up in the Master Trader series because he's really very, very good. I highly recommend that without any qualifications at all. Okay, I'm going to end the show here with the bond market because we've had an interesting situation since we've had that full moon back on September the 19th after the FOMC meeting. We had the market in both Treasury notes and Treasury bonds have rallied strongly since September. We've had this 6-week rally that looks like it's come to an end now because of the big move we've had down. But the important thing about this rally is that Treasury bonds could not even make a 38% retracement of the last high that we had from back in May. And as you know, we've been bearish on this since the butterfly was made in 2012. Up near the 155 level, and now we're trading at 133, so it looks like it's still heading, south. But this time in this rally, the notes rallied to the 50% level. But the Treasury bonds, the 30-year bonds, could only not even rally to the 38% level. So this was telling us that people were in there buying short-term paper. Well, usually with shorter term, that means the notes that are anywhere from 2 to 10 years are the notes, and then the bonds are 15 to 30 years. But the thing is, why are they rushing to safety with the stock market, up near, well, not near historical highs? It is at historical highs. Could it be that they're looking at the fact that maybe that the record high margin debt also scares you a little bit? I don't know. The director of the Federal Reserve of Philadelphia, Mr. Plosser, was on Bloomberg over the weekend, and I happened to hear his little speech. He happens to be one of the few hawks of the 12 Federal Reserve banks. And he said, this is a giant experiment that we've done with this QE3. We don't know what's going to happen. Nobody else does either. And he said the thing that bothers me the most about this is the counterparty risk on all these trades. Who's taking the other side of the trade that you're putting on? Remember, we had this problem with credit default swaps and CDOs, during 2007 and 2008. Of course, we had the too big to fail came in, and the Toxic Asset Relief Program, TARP, came out and bailed everybody out except everybody here at TFNN, including me. None of the little guys were included. It was only the big boys that got their money to play the game again. But could it be that this counterparty risk could be something that would be a, problem, out into the near future? That I don't know. All I do know is that the patterns that I'm seeing in the stock market are as bearish as anything I have seen in all of my years of, looking at this stuff. I spent a lot of time. These are all long-term patterns, folks. These are based on daily and weekly charts going back many years. So these patterns are there, and we've talked about it here today. We're having the same pattern now that we had in the top of 2007. Now, fundamentalist is not going to see that three drive to a top pattern. The technician will, but not the fundamentalist. So this is why I'm a technician, and I hope you are too. But keep in mind that, I'm wrong a lot, but occasionally I'm right, and we'll see what happens. This is it, folks. Live every day in an attitude of gratitude, and may God bless. The Dow is down too.
What's the one thing that pulls people back from the breakthrough that they're moving towards? What's the only thing that really stops people from taking action? You and I both know the answer, and sure, we can come up with the reasons why we're not where we want to be, but the only reason that we don't do more with our life is fear. Or if you're an overachiever, call it stress. Simply put, there's something that happened to us in our past that's holding us back from the life we deserve, yet you and I are okay, we're here. So why should we let our past control our future? Exactly. We shouldn't. Hi, I'm Steve Rhodes with TFNN.com, and when it comes to your trading and investing, I can help you overcome your fear of loss. Together, we'll turn weakness into strength with a system I've developed called Mastering Probability. I'll teach you how to make your money work harder for you than you do for it. I'll teach you the tools that provide financial freedom. Go to the homepage of TFNN.com, click on my name, Steve Rhodes, and begin your journey of mastering probability risk-free. It's time to become a pioneer of your future versus a prisoner of your past.